What is a mortgage? What is a mortgage specialist? Should I use a broker or a loan officer? These and many other questions answered by an expert coming right up. Hi, everybody. Welcome or welcome back to the Real Justine Priestley channel. I am the Real Justine Priestley, your local realtor with a twist here in the Greater Vancouver area. This video features special guest star Sean Chapman, who is a 29-year mortgage veteran, mortgage Yoda, a mortgage guru, and he's going to answer all of our questions. Let's get into it. Hi, Sean. How you doing?
Good. How are you?
I'm good. Tell us a little about who you are and how you got to be so fabulous.
I work for RBC Royal Bank. I've been working for the bank for the last 29 years. 19 years in the role of mortgage specialist, or should I say mobile mortgage specialist. I've enjoyed the role a great deal. It's been a fantastic change from working in the ranch to being able to be out and about, meet clients, focus on one product and become an expert in that one product. We live in a great place to, real estate wise to do what I do, and wouldn't want to do it any other place.
Yes, Vancouver is the best. We all agree on that. Let's start at the very beginning, how complicated mortgages can be. And I think how every mortgage is different too, right? Like every person, every deal is different. So let's start really basic with what is a mortgage?
So, and you might say, compare it to a loan. Take a loan. A loan can be secured or unsecured. Credit lines are unsecured. They're considered a loan. Some people get like an RSP loan, that's not secured. Or they can get a vehicle loan, which is secured by the vehicle. And majority of the time, a loan, what we call the life or the amortization of that loan is usually about 5 years max. On vehicles, they'll go up to 8 years now. Whereas when you look at getting into properties, into buying a land with a home on it, or buying a condo or buying a townhouse, now we get into what we call a mortgage. A mortgage is secured by that property, by that residential property, and allows us to go to 25 years amortization, life of the mortgage, if you do less than 20% down, or 30-year amortization if you go 20% down or more. The idea of having that longer amortization is so that we can keep the payments reasonable and low enough so that the individuals can afford to make those payments.
And that's a great opportunity for you to smoosh the light. Smoosh. What are the steps that you would tell a person to do who's never had a mortgage before but wants to get into the market? How do I get a mortgage?
So the first thing, and I say this with every client, get in sooner rather than later. So if I can get a client 6 months out, a year out, to me, that's better. Even if it's just to have a discussion with the people that have done it before. But for the people that are new to it, the sooner you can get to them, the sooner that we can sit down, go through the process, load an application, do what we call a mortgage pre-approval, the better. Because once we know what that person could be pre-approved for, we're giving them an idea of what they can go out and purchase or what they can go out and put an offer in on. When we do a pre-approval at RBC, what we do is we get your income confirmation up front, we get your down payment confirmation up front, we get your assets confirmed, we pull your credit to make sure your credit's clean, and we look at your debt load. We put all of that together based on what you're able to put as a down payment, and we can come out with a number that's a reasonable idea of what your maximum, what I call purchasing power is. At RBC, when we do approvals, we do what's called a firm approval. And it's a term I like to use because once RBC approves you for the purchase of a property, that's it, we're done. There's nothing else that RBC requires from that client documentation to provide. Yes, we've got to sit down after that and go over everything, make sure we've structured that mortgage the way they want, the payment frequency, the interest rate, the term, the amortization. Some people like a shorter amortization. And we sign the basic documents, which then allow us to send mortgage instructions to the notary or lawyer of their choice.
So you are a mortgage specialist. What is a mortgage specialist as compared to a mortgage broker or just a regular kind of bank loan officer?
To differentiate myself to a loans officer does it all. They open accounts, they do investments, they're the full meal deal. Whereas As a mortgage specialist with RBC, that's all I do, mortgages. I don't do anything else. So it allows me to be an expert in that. The beauty of working for a company like RBC is that I have them behind me. I also, once that mortgage advances, a client can reach out to me, text me, phone me, email me, ask questions about their mortgage, ask questions about, options, things like that, and I can respond. That's why I've never thought of or even wanted to look at becoming a broker. And it's not to say a broker is a bad thing. With a broker, they can, obviously place it with different lenders and look out for different rates, things like that. But once that mortgage advances, you're done with that broker. That broker cannot assist you further with any questions or anything you need to know about that mortgage. They will give you a 1-800 number, and you'll have to deal with somebody on the other end that you don't know. And that's, again, why I much prefer our way of doing things, which allows us to maintain that stronger relationship and long-term relationship, because that's exactly what it is.
And so when people's mortgage goes along, there's different points where things can change, right? Like your term can change. You might want to refinance, just all different things. And so a mortgage specialist can help you with that all the way through the process, right?
You got it. Absolutely.
Please tell me the difference between a fixed term and a variable, and how do you know which is right for you?
The difference with a fixed term and a variable term is we have open and closed. The open term is something that is, you can pay it off anytime. There's no penalties, but it's also a higher interest rate. And we use those two terms for short-term financing. Client comes up for renewal, they're going to sell their place and they don't want to lock into a closed term again. We put them into an open term. That way, when they do sell, there's no penalty. Closed terms, fixed or variable, are terms that you're locked into. To get out of them early, you'd have to pay a penalty. With a fixed term, that penalty is either 3 months interest or interest rate differential, whichever is higher. The interest rate differential, or IRD penalties, can definitely be quite a bit bigger than that 3 months interest. Whereas with a variable term, it's only 3 months interest that you would pay. There is no IRD on a variable rate term. Variable rate is you're locked into the term, but not the rate. The rate goes up and down based on prime rate, which is set by the Bank of Canada, usually about 8 times a year. The fixed rates are set by the bond market. So whenever the investment market. So whenever you hear that bond yields are on the rise, pretty much guarantee fixed rate mortgages will be also on the rise. As for what makes a good interest term for each client, it's all different. Clients that go variable are clients that can handle the risk, they can handle the volatility. They're okay with that up and down. Over the long term, if you do take variable, most clients have come out on top. They've done better than if they had gone fixed. The challenge is you've got a very large debt, and most people want to be able to sleep at night. So the majority of people go into fixed terms. When we sit down with a client, we don't direct them one way or another. We give them the information on each, we give them the choice, the options of each. We do give them some advice as to what maybe makes more sense for them. But at the end of the day, the client makes the final decision.
But most people choose a fixed term.
Absolutely. When you're talking 500,000, 600, $1 million is borrowing, people want to be able to sleep at night. And that's why the majority go fixed.
If somebody wants to ask, how can I get the best rate for my mortgage? What would your answer be?
Every institution, Royal Bank, TD, CIBC, brokers, we're all very competitive. They definitely look at rate, and that's a priority, and we're always competitive. But they also want to look at that relationship where they want to know, they can pay it down in a timely manner. They can make those extra payments. If they want to make changes to it, how easy is it to do that? With RBC, like I've said, we have our branches you can come into. We have our 1-800 number. You can do it digitally through your online banking, through your phone. You can talk to a mortgage specialist, like myself, ask questions about that. So for me, it's not just about rate. We definitely want to be competitive with that, but there's a lot more to it than just that.
The internet wants to know, can a person get a mortgage who doesn't have a job?
In very few instances, they can. But again, it's a bit more challenging. It's most of the time with the way the federal rules work as far as lending on mortgages, it's based on income. And I like to say to clients, income is king. It's based on down payment. It's based on credit history. It's based on debts currently owing and the payments on them. And it's just based on that overall application. So at the end of the day, yeah, you can get a mortgage without having a job, but it's usually a good idea to have one to show you have the capability of paying it back.
And what if somebody is self-employed? Then is it all just tax returns that you go on?
With self-employed, it's a bit different. How I like to position is the income we get to use is people's taxable income based on their personal tax returns. So for somebody that's employed, we can use their gross income. Why? Because that's what they get taxed on. For somebody who's self-employed, they don't get taxed on their gross revenues through the business. They get taxed on the net income that they declare on their personal tax returns. And we use a 2-year average of that. Self-employed, we do have specialty programs for clients that are able to put 35% as a down payment. It's called stated income, meaning we can, depending on their overall financial picture with the company and whatnot, we can actually bump the income up and get them approved for a higher dollar amount than we normally would based on what they declare.
Let's talk a little about how much of a down payment a person needs if they want to buy a property.
In Canada, when you do less than 20% as a down payment, your mortgage must be insured through what we call a default insurer. It charges an insurance premium that gets added to your mortgage balance. So the minimum down payment up to $500,000 purchase price in Canada is 5%. Then from 500 to just under 1 million, you have to put 10% down on that amount. When you do 20% down as a minimum, there's no insurance premium. You don't have to be insured with a default insurer. And it's only the lender, i.e., in my case, Royal Bank, that needs to make the final approval decision. With what we call a high ratio or less than 20% down mortgage, the lender makes the first decision, they send it to the insurer, and the insurer has the final say.
So if I have a pre-approval already in hand, why do I still have to wait and make a subject on my offer of 5 days or 7 days if I already have a pre-approval?
The answer to this and many other questions coming soon in part 2.
Do you have a question about mortgages that we didn't get to in this video? Drop it in the comments. Do you ever worry that you might be annoying your realtor? Well, you're probably not, but if you want to find out more, watch this video right there.